Missouri S&T for hosting our meeting of the Board of Curators. And to start the business, the chair would entertain a resolution to go into executive session at a later time today.
Second.
Cindy?
Curator Covington?
Yes.
Curator Cupps?
Yes.
Curator Graham?
Yes.
Curator Henriksen?
Yes.
Curator Phillips?
Yes.
Curator Snowden?
Yes.
Curator Steelman?
Yes.
Okay. All votes in favor.
The first item is the Finance Committee, and Chairman Covington, if you want to make the introduction.
I will. Thank you, Mr. Chairman. First of all, I would say to my colleagues, we have very substantial material to cover this morning. This is an informational meeting, and we are focused exclusively today on asset allocation. We do have visitors, guests from the outside world as well, and Vice President Burnett will be making introductions, and then Mr. Richards will as well. But simply, I don't want to overreact in my role as field marshal here, but do want to remind us that we have lots to cover in this fairly brief period of time considering the subject matter. So I'm going to hope that we keep on track. There are a couple of issues always embedded in what we're doing that we have visited more than once and will in depth, but let me underline in the future. One is our anticipated rate of return. The other is the ongoing conversation about active versus passive in terms of distribution of our investments. In due course throughout the year, we will be going into those issues in depth, but today, again, I repeat, we're focused on asset allocation. And with that, I'll turn it over to Ryan.
Well, thank you, Curator Covington, and members of the Board of Curators. Thank you for your time this morning. As you saw in the advanced materials we sent, there is a great deal of information here, but as it should be when you're talking about investing billions of dollars entrusted to you as curators for both our pension system and our endowment funds. So I'm just here to echo what Curator Covington said. Today is really about helping the board understand a recommendation to adjust some of our asset classes within both the endowment and the pension system. There's a good 3-page summary at the beginning of your materials about it, but today, in the next 2 hours, we have a number of people to help you walk through how we got to this recommendation. And again, not for action today, but at a future meeting. So with that, I'd like to introduce, you all know Tom Richards, Associate Vice President and Chief Investment Officer and Treasurer of the University. He'll lead this, and then we'll have Barry with SIS and our folks at NISA as well. And we are saving time at the end for questions from board members. So please understand we're going to move through this deliberately, but we want to make sure we have time for questions. So thank you. Tom?
Good morning. Uh-oh, I just hit something. There we go. Okay. My favorite topic, investments and asset allocation. And again, appreciate very much your willingness to come this morning so that we can devote some extra time to this topic. We've got way more material than we'll have time to cover. Some of this we're just introducing some concepts that will be part of an ongoing discussion with the board and some things that we'd like to do going forward. I kind of talk about some of these things that we're proposing is not the end point where we want to be, but sort of incremental steps along a journey of where we wanted to be headed. And so we want to talk about some things and revisit some things that we've talked about with the board previously, although with turnover on the board, we need to keep going back and hitting on some of these concepts. And again, we will want to follow up going forward as well. Just as a brief overview, again, to give some perspective, we're talking primarily about the retirement plan and the endowment pool, and this is just to give you a sense of the magnitude relative to the university. This happens to be for fiscal year 2014, gives you an idea of the balances, but also the cash flows that come through both of these plans. The retirement plan in particular, I know we may be talking about that afterwards, but in fiscal year 14, we paid out $173 million in benefits. That number is important, and this is important really for a future discussion, but as the population ages, that number that goes out for benefit payments is going to continue to grow rather quickly. At some point, that'll have an impact on how we invest the retirement plan in terms of the liquidity that we need to meet those benefit payments. So it's something we're looking forward to know that it's got to be addressed. Right now, it's not an issue. Asset allocation, again, generally is addressed by the board every 2 to 3 years. The last time we came before the board for target adjustments was in June of 2012. Three main things, three high-level things I'm going to touch on, and again, can't go into as much detail as we'd like to, but just to throw some basic overview concepts out in terms of how we're looking at the portfolio, which will kind of inform where we want to take the portfolio going forward. The biggest thing, which is not necessarily new, and it's not striking, it's pretty simple, but it's an important thing to throw out. It has to do with how we view risk and what really is a diversified portfolio. Typically, when you hear discussions, I mean, even about our own portfolios with our own personal finances, if we were to talk about a portfolio that's 50% equities and 50% fixed income, we generally might talk about that as a diversified portfolio, like if it's our own, that we're well diversified. That would be a picture on the left-hand side of the screen. That's really diversification from a capital perspective or a dollar perspective. But if you think about it in terms of the risk perspective, and then thinking about how the risk is what really drives your returns and your performance, that 50-50 mix in terms of how your dollars are invested from a risk standpoint looks like the graph on the right-hand side of the screen, which basically says if you have a portfolio that's 50-50 equities fixed income, the performance of that portfolio is basically going to follow whatever equities do. So that's maybe not good, bad, or indifferent, but it's something to be aware of when we're talking about building a diversified portfolio and why that's important to us to think about as we try to add to the diversification within the portfolio. Not to say that equities at all are bad. In fact, just looking over time, there's no doubt that equities over time perform very well, and maybe it's the best place to have your money if you're talking about a long time horizon and you don't have needs to access the cash necessarily at the wrong point in the market. If we look at the S&P, just as an example, if you put $100 into the S&P in 1928, by 2014 it would have grown to $290,000. It's a pretty good return, pretty good investment. In fact, it was. Interestingly, if you take a look at the annual gains and losses in the S&P, and you take out just the two worst years since 1928, that would have been 1931 with almost a 44% loss, in 2008 with about a 37% loss. If you could have avoided those 2 years, you would have ended up with $814,000 instead of $290,000. The point being is that equities are a great long-term investment. They're a rocky ride. And when you're running retirement plans, which have to pay out benefit payments every year that we talked about earlier, or even endowments where you have to make annual spending distributions, that volatility is important to manage. So what would be better? So if we go back again just quickly, if this is in fact what a 50-50 portfolio would look like, dominated by equity risk, again, that would be good when equities are performing well. But there are times when equities don't perform well, and you wouldn't like that portfolio. So what would be kind of an optimal portfolio? So we talked about how we'd like to focus on balancing the risk of the investments as opposed to the dollars allocated to them. The other concept would be to build a portfolio that would be balanced based on what might happen within the economy. This is work that's been done by Bridgewater that's led to the formation of what's now known as risk parity. And their view of the world and the economy is that the economy can be explained by really two factors: growth and inflation, and whether they're rising or falling. And you can boil things down basically to that level of simplicity. So then we kind of think about within each one of those sort of quadrants of what could be going on in the economy, what are the asset classes that have characteristics that perform well when we're in that kind of an economic regime? And this is just a very, very simplistic, high-level overview to show you that in these different quadrants of the economy, if you're in a period of rising inflation, TIPS, commodities, emerging market credit, those would be the types of asset classes that you'd want to hold and would do well in that environment. Rising growth, of course, equities, commodities, corporate credit, et cetera. The point is not to get into the detail, but really to say that if you want a truly diversified portfolio, you want to diversify that portfolio based on the risk, but also based on what could happen in the economic environment. And the reason that that's important is that although we all think that we're smart, and all of our advisors, in fact, they are smart, but no one can really predict what's going to happen in the markets. So the better prepared that we would be in the portfolio to deal with whatever would come, especially as long-term investors, the better off we'd be. There's no better example in recent times than the price of oil. So how many experts did you hear last summer talking about the coming crash in the price of oil? All the information was there, the data on the supply and demand imbalance, the geopolitical issues, all that was out there, all of that was known. If you look back now with hindsight, it's pretty clear, how there might have been a problem. Who was talking about it? Just about no one, because it's nearly impossible to predict with any level of precision what will happen in the markets. So balance is better. And this is kind of the core driver of a risk parity portfolio. We included some pieces in your board materials that get into a little bit more detail on risk parity. We don't have time in this presentation to go much further, but we did want to touch on the concepts, because one of the objectives that we had in this round of asset allocation is to increase the balance of the portfolio from this perspective. So if we take a look at the retirement plan, our current asset allocation is on the left-hand side, and the proposed asset allocation is on the right-hand side. You can see that we're sort of slanted towards rising growth and falling inflation, which is exactly what you would expect to see in any typical traditional portfolio. Our biggest objective, again, was to help increase the balance incrementally right now, and you can see the area that we made progress in was in rising inflation environments. So we have the smaller slice of red at the left, the larger slice of red at the right. We've built in some things into the portfolio which will offer us more protection once inflation starts to rise. The blue bar, though, at the bottom, falling growth, you can see is just about the same. So why were we not able to make progress with that? Well, if we go back to this slide and look at the asset classes that tend to do well in falling growth environments, they're bonds, government bonds primarily, and think about where the returns, where the yields are on that right now. It would be extraordinarily painful to be building more of that into the portfolio in order to achieve that balance at this point in time. The endowment is pretty similar. The only thing I'd point out in the endowment is that the blue bars at the bottom, so the protection in falling growth, is a little bit less in the endowment than in the retirement plan. All that really says is that the endowment is taking on a little bit more risk and a little bit more position for growth. And that gets to sort of the underlying risk tolerances that we might have with the endowment versus the pension plan. And part of that gets into the need for the cash flows, the benefit payments, things like that. We can and probably should take on a little bit more risk in the endowment pool. Just to sort of wrap up the risk parity discussion, and I've got more detail in your board materials. We've actually taken the existing retirement and endowment portfolios and the proposed portfolios as well as risk parity, and we've shown you in the materials what the performance would have looked like in various different economic scenarios going back roughly over the last 30 years, including, I think, every recession that's taken place. And the point being, risk parity tends to perform well across the board, although not always. And there certainly will be periods of time when our portfolios, even the improved portfolios we're proposing, will suffer, as any other traditional portfolio would. We got the hanging A and the alpha. So this is kind of a basic equation that we're going to walk through pretty quickly, again, at a high level. This, again, will lead to more discussion later, at a later future point, about risk parity. But you can kind of take the returns of any portfolio and break them down into three basic components. You've got cash, you've got beta, which I'm going to explain, and then you've got alpha. So the fundamental building block of any investment return is whatever the rate of cash is. So if you think about it, if you are paid a salary, collect a retirement pension check, or what have you, you start off in a default position of cash. And then you make decisions from there in terms of whether you leave that money in cash or whether you are willing to invest it, tie it up, take on additional risk, et cetera, in return for some kind of additional payment. But the starting point is cash. And kind of with what's going on in the markets today, cash is again, roughly zero, which you're all too familiar with. If cash were at 5%, which it was within the last 10 years, your decision-making might be a little bit different. If you could have your money sitting in cash and earn 5%, you might not be as willing to take on some additional risk and trying to reach for that additional yield. The point being is that in terms of behavior in the markets and decisions to get into different asset classes, it all starts with the evaluation of cash. And then, more complicated than we'll get into, the returns of the other asset classes are ultimately driven by the returns on cash. So beta, in this context, and again, this is a very high-level way to think about it, beta is like that premium that someone's willing to pay you beyond what you're already getting in cash in order for you to take on additional risk. So, and I'll just go to the next slide, easier. So this is kind of looking at excess returns over cash since 1970. And there's nothing surprising here. You've seen this before. If you go into nominal bonds from cash, you're going to pick up additional return. You're going to take on some additional risk. If you go out to equities in the upper right-hand corner, again, you're going to take on additional risk, but you're going to get additional return. That additional return that you're getting in exchange for the additional risk that you're taking on above cash is what we're calling beta in this context. And beta is basically just what the market gives you. It's sort of the generic thing. If you think about equity markets overall or the bond market overall, it's just market beta. There's no active management or skill or anything within that. So then we're left with alpha. So alpha, number one, is a zero-sum game within the market. So if someone's exercising manager skill and they're able to deliver a return beyond what the market would pay, that means that someone else is on the other side of that transaction and they're taking a loss. So we think about the markets overall, alpha is zero sum. So then it comes down to your ability to select managers and how you go about doing that, which is part of a topic for later in the presentation about portable alpha and some things that we're proposing. So what does all this mean? This is a slide put together again by Bridgewater, who's a very strategic partner of ours. And this, to me, when we're talking about return expectations over the next couple of years, and I want to distinguish that because that's different than the longer-term horizon. But if you think about the environment that we're in today, and you can kind of understand this concept of a portfolio return being cash plus beta plus alpha, if we go back and look at a traditional portfolio return since about 1970, it's returned 9.8%. But 5.4% of that has been basically cash. And if you think about that, that kind of makes sense. If you think about the periods that we were through in the late 70s and the 80s and think about what the cash rates were, the Fed funds rate. So it's kind of easy to see how that would make sense. But more than half of the return of a traditional portfolio since 1970 has been due to cash. The beta component we talked about, if you add it all together, would be about 4.4%. Alpha is a question mark, again, because it's a zero-sum game, and it's nothing that we can really rely on with any degree of certainty. So what does that say about today? Well, without being able to predict anything, and worrying about being right or wrong, we all know where cash is today. That's a given. And we pretty much know where cash is going to be in the next year or two because the Fed's basically telling us. So the only point of this is that in this near term, maybe within the next 3 years, 3 to 5 years, it's just saying that returns overall are going to be extraordinarily challenged from this perspective alone. But there's also another perspective, which is kind of a different, sort of different issue altogether. This is a slide of the Shiller price-earnings ratios of the S&P 500 since 1926, if I'm reading that correctly. The Shiller PE ratio takes, again, a longer-term sort of weighted average of earnings, I think, over roughly a 10-year period in order to smooth it out. But this gives you a sense of where valuations are in the equity market, at least in the S&P 500 today. So if you look historically, we're at about 26 or 27 right now, and it's certainly not the highest we've been. It's not near the peak in 2000, but relative to history, it's pretty high. So what does that mean? So this graph, which you've got in your materials, you can't read it up here, what one of our other firms, AQR, did is they took this data, this Shiller PE valuation data from 1926 forward, and they looked at every successive 10-year period starting in 1926. So 1926, 10 years forward, 1927, 10 years forward, et cetera, all the way up to today. And they created these ranges of starting valuations in the deciles. And again, you can't read it on the screen, but where we are right now is in the 10th decile in terms of the range of that 26 I showed you on the previous slide. So again, this is not trying to predict anything. This is just saying, based on history since 1926, in a given 10-year time period, when valuations have started in that range at the 10th decile, the average subsequent 10-year return was 0.2%. The worst return was 6.6%, a loss, and the best return was 5.6%. So again, this isn't saying what's going to happen or not going to happen. This is just looking at almost 100 years of history based on where starting valuations were. And again, it's kind of somewhat intuitive, and it's talked about a little bit in the media, where the Fed's been encouraging people to go out onto the risk curve to grab that beta because cash is at zero. And what's kind of happened is that equity valuations have been driven up because we have a lot of cash chasing the securities. And so the valuations have been driven up, which really means that we've captured some of the earnings of the future and pulled them back into today, which really means that the next several years are going to be somewhat of a challenge. Now, having said all that, I'm going to sound like I'm going to totally change and go in a different direction, but I'm really not. I did want to address the return assumption on the pension plan, just to put in perspective, versus the policy portfolio that we have today and the one that we're proposing. When we had the last discussion with the board, one of the things that we focused on was really keeping in mind and focusing on and comparing the real return. So our return assumption for the retirement plan is 7 3/4. The inflation assumption is 2.75 for a real return of 5%. If you look at what our current portfolio looks like in terms of projections and the proposed portfolio, we're above that hurdle on the 5%. And that's really the key thing to be focused on. Now, why is that different? It's largely in the inflation assumption. You can see our assumption for the retirement plan is 2.75, and the current market assumption over roughly the next 10 years is about 2.1%. So it's a difference in time horizon, which is perfectly appropriate because the time horizon on the pension plan is closer to the 20 to 30-year range, and we're looking inside a 10-year time period. So for that purpose, this really isn't an issue at this point in time. And that also doesn't conflict with the idea that the next couple of years are going to be a challenge, because even our market assumptions that are in the current proposed policies are really looking at a longer 10-year plus time horizon. So some highlights of some recommended changes, and just to kind of set up what we're going to go through, Barry Dennis from SIS is going to come up in a second. He's going to walk through the actual process that we went through, which Takes many months and many iterations, but he's going to talk about what we did to kind of come up with an optimized portfolio, which led to the recommendations that we're making to you. And then after Barry is done, we're going to bring up NISA, and I'll explain that when Barry is done. But NISA is going to talk about one of the specific recommendations. And then after we get through that, I'll come back up and talk a little bit more specifically about the recommendations for the changes in the investment policy. But at a high level, we talked about the risk parity concept. We're going to propose a permanent risk parity allocation in the portfolios of 10%. And again, I look at that as somewhat of an incremental step, but it's based on our fundamental belief that it's the right way to run a portfolio, at least part of a portfolio. And I'd also add that there's information in your board materials that kind of gives a chronological outline of the discussions and the actions that we've already had on risk parity and discussions that we've had with the board. So this has been ongoing for 2 to 3 years at this point. We're also going to talk about implementing a portable alpha program. We're going to talk about what that is and why we want to do it. We're proposing commodities as a new asset class, and just to tie that back to that 4-quadrant graph, commodities is one of the areas that gives you some protection, some additional protection in a rising inflation environment. And we're not market timers at all, but this may not be a bad time to be investing in commodities right now, given the losses that have been incurred in valuations across the board. We're also going to talk about creating an opportunistic debt class that's really going to result or come from our existing high yield and bank loan manager allocations. Our goal was to improve the portfolio balance, which I showed you with those 4-quadrant graphs. We've been able to do that incrementally. And then we also wanted to improve the portfolio risk-adjusted returns, and Barry's going to go into that in a little bit more detail. So we set out to do really the 2 bottom things. The things above are kind of the things that have come along that are going to help us do that. The final point, which is going back to the beginning point I made, these are all, in my mind anyway, incremental changes on a path and a journey. This is not where we want to end up, but this is taking incremental steps in a direction that we think is an appropriate place to go in terms of managing the portfolios better and more efficiently. And we would hope to gain the support of the board, get these things implemented, and then continue on that path and come back to the board with additional incremental improvements, because we think that there are things that we can do, and working with strategic partners like Bridgewater and AQR and PIMCO and NISA, which you're going to hear from, we know that there are improvements that we can do. They also take time, and we have to be reasonable about how much we can tackle at once. But again, just to stress, this is a journey, and we are moving down the path. And with that, I would like to bring up and introduce Barry Dennis from Strategic Investment Solutions. And just as a reminder, because we do have new board members, the investment consultant is one of the few relationships that's actually selected and approved by the Board of Curators. And we did an RFP and a national search, I think, 3 years ago, 2012, and the board members were involved in the final interviews, and the board was very involved in the decision. SIS is independent, obviously, of us. They're also independent within the industry. They're not connected with money managers and take no fees from them, so they are an independent voice. And they're what I would call, in a lot of respects, an extension of our staff and provides us with the resources that we don't have internally. So with that, I'd like to turn it over to Barry, and he'll walk you through the process.
Thank you and good morning. If you kept up with Tom for the last 20 minutes, you're not going to have any problem keeping up with me. That was some pretty complicated stuff he presented to you. We've been working with Tom and his staff since fall on this study. A lot of work has gone into it. We're going to be showing you a summary of that work, but we invite questions as we complete the presentation. So the process we used in this study was exactly the same as what we did in 2012. What's different is the markets have changed. In 2012, we were prophesizing that equities would be very strong, things like high yield debt would be very strong, and those things have panned out. But trees don't grow to the sky. So the things that we thought would going to do very well and actually did well over the last 3 years have been downgraded. So that's what's changed. Now, for both the retirement and the endowment, the process is to develop a list of portfolios from sort of conservative to aggressive, but the commonality is that they're all what we'd call efficient, that you're getting maximum return for the level of risk you're taking. The second step is to run those efficient portfolios through a model that simulates the future, the financial condition of both pools. In other words, we look at a future balance sheet and income statement for each of the pools so we can get a feel for what they might look like if we adopt that particular allocation as an investment policy. And the model gives us a range of outcomes. It's a Monte Carlo model that assumes or projects about 5,000 different outcomes per year. And once we have those pictures, then we can get a good idea of which of these allocations best meets our various financial needs. I don't want to scare you, but what we're doing today, asset allocation, when we look back 5 years from now, is going to explain about 80 to 90% of the returns that we've earned. Not specifically the returns, but the variance around the mean expectation for those returns. But it will explain a lot of the returns. The estimates run from about 50% up to maybe 110%. It can go over 100 if we don't perform as well as the policy. So it's a very important decision. It's not that we don't spend a lot of time on the middle and the top of that triangle. We do. I mean, we can add value there as well. But this is where we spend the most of our time on these big decisions. Let's go back to statistics class for a second, just so you understand how we're proxying risk of an investment. And we're using something called standard deviation, or how things may vary from their mean expectation. This is a university, and I know we've experienced great inflation over the since I was in college, but it used to be that a bunch of people got C's, smaller amount got B's and D's, smaller amount got A's and F's, and it formed what we called a normal curve. Exactly the same thing with the distribution of securities returns. So if we look at the bottom panel there, which would be over the last 90 years, the results of a 60-40 balanced portfolio. On the vertical axis, we have a frequency distribution. How many years did the return fall within those buckets along the horizontal axis? And you see sort of a normal distribution, a bell curve, forming around those distributions. The standard deviation of this particular 60-40 portfolio is 14%, around a mean return of about 9%. So about 2/3 of the observations fall between -3, 9 minus 14, and 23, 14 plus 9. So that's one standard deviation. It defines 2/3 of the observations. 2 standard deviations is plus or minus 28% around that 9% mean. Those happen between 67% of the time and 95% of the time. The really good or really bad stuff happens. Not very often. As you can see, it happened in 2008, happened twice during the Great Depression. That's 3 times in the last 90 years. A statistician would tell you that should only happen once every 500 years. So these things, bad things, tend to happen more than a normal distribution would suggest. And I want to assure you that our models account for what we call fat tails in the distribution. Okay, let's begin on the work that we do. In order to do this properly, we have to come up with some expectations on how securities are going to behave over the next 10 to 15 years. And asset allocation is the most important thing you do, the most important thing we do is come up with these forecasts. We go through a very diligent process. I'm trying to summarize it on one page. We actually produce every 6 months about a 100-page document that explains what we do. I would say if any of you are suffering from insomnia, let me know. I'll send you that document, and it's guaranteed to cure it. The important things here, third bullet, tendency to mean revert. So things that have done better than expected in the past are expected to do less well in the future, and vice versa. That's important. The other thing is we incorporate all the data we can get our hands on, whether it's inflation estimates, the yields on different bond securities in the market, GDP estimates from the leading economists, and the dividends that stocks are paying. Those all go into our forecasts. Where we stand today is we think we can get about 8% out of the global stock market. Now, the global stock market includes the US, which makes up about half of the global stock market. And about 90% of that half is in what we call big stocks, large cap stocks, and about 10% in small cap stocks. Outside of the US, we break the world into developed markets, things like the G13 countries, and emerging markets. The developed markets make up about 75% of the non-US market, and the emerging markets about 25%. But altogether, we think we can get about 8.1%. Compare that to, under diversifying, global fixed income or global bonds, where you get 2.7%. Subtract 2.7 from 8.1, you get 4.8%. That's what we would call our global risk premium. That's what you're getting paid for, what Tom was talking about, for taking risk over the bond market into the stock market. Is that high? It's higher than average, but it's a lot less than it was 3 years ago when we did this study. So you'll see a little later, we're going to take some of those winnings off the table in terms of our allocation to stocks. We break this into 3 categories. It's another way to look at asset allocation. So we have the things that are going to do well in a high growth environment, things like stocks or your private equity, which is really stocks in disguise, stocks that aren't traded on the public markets. And then in the next bucket, diversifiers to equities, things that will do well when equities don't do so well. Those are primarily fixed income. And we have a new bucket, inflation. We haven't experienced inflation since the early 80s, or at least a lot of inflation in the United States. At some point, that has to come back. So we're beginning to build some inflation protection into the portfolio. We do that through things like real estate, global inflation-linked bonds, those are what we call TIPS, and commodities. I'll talk a little bit more about commodities. You see the return expectation is pretty low for the level of risk, 3.8 versus 30. So commodity prices bounce around a lot more than the stock market. But yet you don't get a very high return for it. Point is, you shouldn't put all your money in commodities, but putting a little bit of your commodities is like buying home insurance on your home. It's an insurance premium against unexpectedly rising inflation, which is bound to hit at some point. Don't know exactly when, but it will. So now we're getting towards the punchline. I want to say we're showing you just where we are currently in terms of policy and where we're recommending that we go. Working with Tom's staff since fall, bi-weekly meetings, we've literally looked at hundreds, perhaps 1,000 different asset allocation alternatives. We've looked at hundreds of thousands or millions of simulated results. Bi-weekly meetings, we came up with a central point that we worked over with your investment advisory committee back in February. The advisory committee had some small changes, but in general, we're very comfortable with where we were going, and those final changes have been incorporated to the recommendation you see today. So current policy is what we recommended and was adopted 3 years ago. Recommended policy is what we're putting forward for your approval later on. Down at the bottom, let's start there. Back when we did this in 2012, we thought your current policy would return about 8%. Today, that same portfolio has a return expectation of only 7.3%. That's what I'm talking about in terms of mean reversion. Not only that, but 3 years ago, we thought the current policy had a risk of 13.8%, and today, despite the return going down, it's a little bit riskier, up at 13.9. So in our efforts to improve the portfolio, given the changes in market conditions over the last 3 years, we are recommending a policy that is significantly more diversified. And by that, I mean the big bullet concentrations we saw in 2012, global equity, are going down. Those concentrations are being reduced. A big bullet in opportunistic debt, that's the high yield stuff. It's a lot like equities, that's going down. Those assets are being redeployed into things like commodities, a new asset class that will diversify the portfolio. The bottom line is relative to if we just kept the same policy, we're improving our expected return from 7.29 to 7.47. Not a lot, but we're adding about 20 basis points improvement, but at the same time, lowering the expected risk from 13.9 to 13.8. So we're improving the risk-reward trade-off of the portfolio as represented by a higher Sharpe ratio at the very bottom. So here's a couple other ways to look at risk. The first one, the range of return, and we're comparing the current policy to the recommended policy. You can see in the middle of the bar, the dash, the expected return goes up, as I showed you. But the range of return comes in, so we're lowering the risk. We're lowering the impact of extreme outcomes, not only the bad outcomes, but the good outcomes as well. If you look over to the right, and this is the key one, and this was what Tom was talking about in diversifying our exposure to economic regimes. We're betting less that we're going to have a high growth environment. And we're betting a little bit more that we need to diversify those growth assets and we need to prepare more for unexpected inflation. Now, if you look at the top, those changes are fairly small, but if you look at the bottom, how our actual risk is allocated, we really step up our exposure to unexpected inflation in the future. That goes from 6 to 15%. And we think those are good changes to make in the environment today, and given what's happened in the last 3 years. Other ways to look at this, and here I'm getting into your balance sheet and your income statement. We don't think these changes are not big enough to change the outcome of your funded ratio, so it's expected to stay at 87%. Over at the right, again, not big enough to change the outcomes of what you have to pay as a percent of salary to fund the retirement benefits, but it does go down a little, both at the worst case scenario at the top of the bar and at the median, you see it go down from 7.5 to 7.4. Lower left-hand corner, we call this ultimate net cost. Do you remember the ads for Fram oil filters 20 years ago where the guy said, you can pay me now or you can pay me later? Ultimate net cost is the Fram oil filter variable of pension finance. And it combines the pay me now portion, the contributions you have to make over the next 5 years, to the pay me later portion, the unfunded liability that may exist in 5 years. It combines both of those into one variable. So we think it's a good variable to look at if you can only focus on one pension finance variable. And here you can see at the median, those expected costs go down. This is 5 years into the future, from $889 million to $867 million. So you save about $22 million at your mean expectation. The top of the bar is the worst case. That's how much your costs would go up if we have a market environment that falls in that way to the left column that we saw in 2008. Okay, the worst 2 out of 100, the 98th percentile. And even the bad situations, your costs would actually go up by $2.1 billion, but they'd go up less than if you don't make the change, by 17 million. That's how we characterize the risk-return trade-off, and we actually do the math for you on the next page. So if you look over to the right, if we earn what we expect, our costs are going to go down by 22 million over the next 5 years. If we're wrong about our guess and things get really bad, worst 2 out of 100 type market in that normal distribution, our costs go up less. They still go up, but they go up less by a total of 16 million. We think that's a pretty good trade-off, justifying making the shift from what we have currently to what we have recommended. In summary, for the retirement fund, we had multiple objectives. We want to balance the risk exposures to the future economic regime. I think we've demonstrated that. We want to improve the risk-reward trade-off, and we don't want to take more risk than what we took in 2012. So you can see the recommended policy for risk stays at 13.78, 13.79. We increase the return if we haven't made a change, and as we showed you on the previous chart, we've increased the exposure to what you might call negative or unwelcome economic regimes. Those were the things we set out to accomplish, and we believe that these recommendations accomplish those objectives. The other pool is the endowment. Like the pension fund, the endowment 3 years ago increased its equity exposure, increased its exposure to hedge funds, and increased its exposure to opportunistic or high-yield debt. Like the pension fund, the retirement fund, we are recommending a more diversified policy portfolio. So you can see we are recommending less in equities, that goes down from 49 to 43, cutting the hedge fund allocation in half, adding some protection for inflation by introducing commodities to the portfolio, and adding some expected return by adding a concept called portable alpha, which Nissa is going to talk about in the next presentation. Like the retirement fund, the same objectives were set when we started out on this journey. We wanted to diversify the risk exposures. We wanted to maintain the risk level that was established in 2012, and we wanted to build a risk-return efficient portfolio, a more efficient portfolio. And as you can see from the bottom of the panel, those objectives were met. Here are some of the similar things to what we looked at for the pension fund. However, the finances of an endowment are different. Our outflows are dictated by a spending policy that looks to spend 4.25% of the endowment's value, smoothed out over time. We have an expense of running the endowment of about 85%. And we have an inflation expectation of 2.1%. So our objective here in terms of how much we need to earn in the endowment is we want to be able to grow the real or after inflation corpus of the endowment. And the recommended policy does that by about 0.45% per year versus the old policy, which would have come in at about 0.39. So some improvement in the real return, but also accomplishing the objective of diversifying risk exposures. The endowment was very exposed to a growth environment. We've had a growth environment the last 3 years. Going forward, that's a little less likely. So we are increasing the exposure to the inflation environment, just like we did in the pension fund. A little bit of repetition here, but like the retirement fund, we've introduced some new asset classes to help us with inflation protection and to balance the risk exposures to economic environments. We've maintained the real growth of principal, actually improved it a little bit, and improved the risk efficiency, the risk-reward efficiency of the endowment portfolio. With that, that ends my review of the work that we've been doing over the last 6 months with your staff, and we will take questions at a point later in the agenda.
Yeah, I was going to say, in terms of the timing, we've covered so much material in the first 2 sections, and this might be a good time to pause before we get into a more specific discussion of Portable Alpha.
So are there questions, Dave?
Does this change what you would expect in fees? You could express that in terms of just basis points. How does this change in allocation affect the expected change in fee structures?
That's, I'd have to kind of look at that a little bit more. I mean, that ultimately, again, when we had met and talked, we always look at returns in terms of net of fee returns. So when we're modeling things, fees really don't enter into the discussion because we're always looking at net. You have to think through with some of the changes that we're going to make. Some of them are going to result in less fees. A few of them could result in more fees, and we'd have to see how that would mix together. But the ultimate objective is to produce the highest return we can net of fees.
Well, and the reason I ask that is not just because I understand the discussion of fees and net of fees, but that is a way that I can shorthand access how passive and how active we are. And I think we had a great meeting yesterday, but I'll have some more questions on Total Alpha because I'm not sure the beta section of that is as passive as I thought it was. Mm-hmm. And so to me, taking up the Don Downing movement, Marcy, how it affects our fees is to me a good way of measuring whether we're going more active or less active.
I would say that we are planning on doing less hedge funds in both pools. Hedge funds are expensive.
Though we got Portable Alpha.
I'll get to that.
Okay.
Yes. We are going to be implementing Portable Alpha, which we'll hear about in a minute. Now, Portable Alpha, the beta portion of Portable Alpha is going to be implemented with index funds or something like an index fund. So it's going to be inexpensive beta, whereas today we're paying a lot for that beta. What we're going to port on top of the index fund is going to be a more expensive proposition. So that's going to be a bit of a wash. Like Tom said, we're hoping to get more return for what we're paying in fees. So a more efficient fee structure. And right now, when you pay for beta, you can buy beta for basically nothing. And today we're paying for it. We're going to be doing that a lot less in the future.
I guess what I would like, and not to belabor it today, but as we continue on the discussion, and I was very impressed by the way you did this agreement, to continue on the discussion of passive versus active and chasing alpha. If you could just give an estimate, Tom, at some time by email or whatever, what you would anticipate the change in our fee structure being in this allocation, I would appreciate it. Again, just for the board of curators, because I was going on long before I got here, at least have some understanding. I shouldn't speak for them, they probably already do. It would help me to have some understanding as to whether we are truly going more passive or not.
So, David,
that our philosophy is correct, and Tom Berry, please correct me if I'm not representing our philosophy appropriately. We're talking about the asset allocation and the design, and we've been focused on returns. And your question about are we maximizing our returns in each of the categories by having the appropriate level of management fees is a good one. But our philosophy is to achieve the returns. Number one, obviously we want to try to minimize management expense or make sure that that management overhead is allocated to the right asset classification, and we're doing that. But getting underneath this, the management fees and a discussion about those is secondary to the returns, which is what we're really focusing on. So that's our philosophy. So if you don't agree with our philosophy, we ought to have a conversation about that.
My question, I understand that philosophy.
Yep.
There's an issue, and I'm sure that you got a copy of Don Daffy's email at one time.
I've gotten lots of copies of Don and lots of things to read, and I did read them. They're
And it
good.
really boils down to a more basic philosophy
Yep.
as to whether or not, I believe there's alpha in the market. I
Mm-hmm.
believe that chasing alpha is extraordinarily expensive and actually futile. And there are ways to get that rate of return. For instance, as we know, had we simply been in the S&P 500 in the index fund, we would have outperformed. I'm not saying we should do that because you get into risk.
Right.
And so this is just my way of a shorthand way of measuring whether we are really getting, I understand net of
Fees.
fee return. It is a shorthand way for me to tell whether we're really being more passive or whether we're being more active. Total alpha somewhat confuses me. I understand the concept, except that I have questions on the beta portion of it. But to me, that's why I'm interested in the fees, not because that we're not interested in a rate of return, but I'm interested in what we are paying for the rate of return.
Could I say that at this point, that my understanding is that over time, we have gradually been moving to increased involvement in passive funds. And we, as a board, over time, have approached that with the understanding that paying fees, sometimes some people believe that that's something that should never happen, but we'll probably always, within the board, have some little disagreement on. But there is, my point is that a gradual move toward increased presence in passive funds. And probably the alpha conversation will recur again after NISA, because there will be more focus in that portion of what we're talking about, if I'm not mistaken. Is that correct, Tom? A little.
Yes, and just a general comment, just back specific, taking it back to the recommendations. As we talk about portable alpha, and this gets to your question, and I got to be careful what we say because we have active managers right now. If we're able to go forward with the portable alpha program, it's very likely that we will eliminate active management in U.S. equities, which is a significant step. And again, we've got managers that aren't aware of that yet. But in terms of, again, driving the strategy and what we're talking about here, we've got to be focused on the asset classes and the allocation. Once that strategy is set, then we go asset class by asset class and determine what's the most efficient and effective way to implement that asset class. And some of them work very well in a passive manner, and others it's just not possible.
And I understand that. My question is really much more basic than that, which is if I could have an allocation or an understanding of how the fee structure changes, I would know intuitively whether we're going more active or more passive. And everybody can have a difference of opinion on that. But as Ann was just saying, we've been moving towards more passive, and it will be interesting to me to see if the fee structure is going up, then that means we're not going more passive. Now, it could be right or wrong. I'm just saying for my purposes, that is what I'm interested in.
I share the same interest and understand David's question, and I'm equally interested. And as we narrow our equities and increase some of the other investments, as you just said, some of those can't be done very well passively. And so the question is the net. How much are the fees going to go up as a result of our shifting? And I think we're all talking not about the SIS analysis the overall allocation, but the passive, active management of when you actually change the investment. So some of us are disciples of the Don Downing, and it sounds like we're moving in that direction, which is pleasing to hear. I do have another question. So at the very beginning, when you talked about changing the risk-adjusted returns from 7.75 to 7.47, are we determining that near term? We had that debate coming down from, what was it, 8 to 7.75, and it was an interesting debate, and the auditors ultimately helped us make decisions over that. If we do now or at some very near future meeting, is that going to increase the, now I'm now focusing on the retirement funding, is that going to increase the amount of contributions that we need to make on a yearly basis because we're looking at a lower rate of return?
Just one point of clarification. We are not discussing the return assumption on the retirement plan. That is not a recommendation. It's not a focus of this presentation. I presented that so that we could reconcile back to say that what we're proposing here is not in conflict with the assumptions that are in place. But this is in no way a recommendation to revisit that or discuss that.
Good, thanks.
Thank you. I'm sorry, didn't mean to, does anybody have another question for Barry Dennis or for Tom Richards before we move ahead on the subject of asset allocation? Okay, thank you very much, Barry.
Okay, I'm going to ask our friends from NISA to come up. NISA actually came before the board, I believe it was in October of 2013, to talk about two programs with the board that had to do with rebalancing the portfolio and optimizing our cash balances, and to do that with synthetic instruments, or we could just say derivatives. So we had that presentation, that discussion. The board approved policy changes that allowed that to go forward. And what we're doing now is the portable alpha discussion, which we'll go over, is really another building block on that platform of that discussion that we started back in 2013. This is something from a recommendation standpoint, and in terms of why we're recommending it, we feel it has the potential to add incremental returns to the equity portfolio and also to dampen the volatility. And it's something that we find in talking to peers of similar size and sophistication that we're one of the smaller numbers that are not doing this. And from a return perspective, and we're trying to maximize returns, in some respects, I'd say we're leaving money on the table. NISA is a nationally respected firm, and I mean that when I say that, and they happen to be based in St. Louis, and we're pleased to have them here. And we're pleased to have partnered with them in the past and to look forward to working closely with them in the future. So I'll introduce Robert Krebs to start out. And then again, we're going to focus on NISA as a firm, and it's important because NISA would be the one running the program for us. When we start to talk about derivatives in terms of implementing it, I just want to make very clear that that's not something that the staff is doing mechanically. It's something that we would have NISA do for us. So it's important that you understand the depth and the capabilities of the firm, and they can talk about the work that they do with other clients, et cetera. So having said that, let me...
Just from your own lips and for the purpose of some reassurance, would you like to tell the board what your definition of derivatives is in this context? Or would you rather wait for NISA to go through it piece by piece?
Well, they can talk about it certainly in more detail, but I think the main thing I wanted to convey in some maybe language that was used in the board materials, we're talking about very basic, plain vanilla instruments. So there's a natural reaction when you start to say the word derivative. It can mean so many different things to so many different people. The point that I was trying to make with the materials is these are very plain vanilla, widely traded, very deep markets, and nothing sort of exotic or unusual for institutional investors like ourselves to be utilizing in the management of the portfolio. Excellent question.
Tall as Tom. Well, thank you very much for having us in again. We always appreciate spending time with our clients. It's great to see clients and talk to them about what they're thinking about and what we're thinking about and what issues are. But we have another reason really to be thankful for working with you and appreciate being here. And that really is the great class of graduates that you guys produce every year. We're a big recruiter at Mizzou. We hope you keep cranking them out because we're going to keep hiring them. Before I get started, I'll give you sort of my answer to the derivatives thing, and it won't be what his answer would be, but sort of maybe at a higher level. But Dan's, I'll maybe call a rocket scientist or whatever, but sort of more in layman's terms. In my mind, derivatives help our clients control risk. We're known as a risk-controlled manager, and we help our clients get exposures that they could get otherwise in what I'll call the physical markets being bonds or stocks. But derivatives help a client get exposure or get rid of exposure in these physical markets, but it's a more cost-effective and efficient way to do it in many cases. And that's really what we're doing here. So they're really just tools. They're not, I guess you could use them for speculation, and people do or whatever. That's not what we do. We're helping clients get exposure, get rid of exposure to help control risk. So that's sort of my simple answer to that. But as Tom mentioned, we are in St. Louis. We're a 100% employee-owned firm. We have about 160 clients. They're all institutional clients. We don't do any work for retail, mutual funds, high net worth. All of our clients are large, sophisticated institutional clients, and we like it that way because we like to have big, strong relationships where we can spend a lot of time with our clients, and as Tom, I think, described, be an extension of staff. And that's really our business model. As you can see, we manage $130 billion in assets. Those are predominantly U.S. dollar investment-grade fixed income. And we also manage $70 billion in derivatives, which I just defined. And again, I know Dan will define differently probably, but a lot more detail on this page, but what I guess maybe what I didn't mention back here with our institutional clients, most of our clients are, obviously names that you've heard of like Boeing and Caterpillar and IBM. I mean, large institutional clients that are in a lot of programs like this that have been going on for a long time. And a little bit more specifically here, NISA started managing derivatives in 1998, actually for one of our friends down the street at Jeff City, Mosers. We do a lot of derivative work for Mosers, and then prior to 1998, a handful of the senior members at NISA were managing and utilizing derivatives back in the mid-'80s. So there's been a long road here of sort of this risk-controlled management for derivatives to help our clients. You can see a lot of different programs, some of the ones that we've talked about here, risk parity, portable alpha, a variety of different programs utilizing a lot of the same instruments, but for sort of different purposes, and Dan will talk about that in a little bit. You can see the second dot point up here at the top. NISA, the largest overlay manager in 2013. The data's not out for 2014 yet, but there's no reason to suspect we won't be at the top of that list again in 2014 by pension and investments. And I think that's been the case for about the past 10 or 12 years. And overlay, I guess maybe that's another way of saying they have us ranked as the largest derivatives manager, and that's a list of managers in the world. and the largest if you exclude currencies. We do some currencies, but that's not a large portion. But if you sort of eliminated that as part of this, we'd be the largest derivatives manager in the world. And bringing that back home a little bit, sort of the day-to-day and sort of what we care about here is you know, are we going to handle them right? We're going to do the right strategies and make sure that we mind our P's and Q's as every day goes on. And so maybe an indication of that, last year in 2014, we did almost 4,000 different trades for our different clients for this portfolio. Those 4,000 trades accounted for about 160 billion. I'll say use the word notional, and that's sort of a buzzword in the derivatives industry, but exposure, about 160 billion of exposure. So we're very active, lots of activity. We have lots of people in the operations group making sure that every trade that we do is doing what it's supposed to be doing. And that's really the key here, is this attention to detail. You know, Dan gets to talk about the fun stuff and the strategies and how they work and what we're going to kind of do. But this attention to the detail is not necessarily a lot of fun, but it could be just as important as what the strategy is. And we have lots and lots of people that have been paying attention to that for a long time. This graphic here is a little more fun to look at than some of those dot points, but it really is here to demonstrate sort of the diversity and across the board different types of instruments and different exposures that we do help our clients obtain. You know, whether it's through the equity markets or you know, commodities, different types of programs. Before I turn over to Dan, any particular questions about NISA or sort of big picture questions for me? Nope. Okay, good. Thank you.
All right, great. I'm looking forward to this. I think this will be a good conversation. I think, first, as a reminder, has been mentioned already, in 2013, we were last here talking about cash securitization and rebalancing programs and the use of derivatives, specifically for use in those programs. And I think some of the key takeaways, those are the bullet points on the page, but some key takeaways from that conversation were derivatives are often a very low transaction cost way, very efficient way to adjust exposures in your portfolio. And so the use of them can help you implement portfolio allocation decisions, help you implement strategies in a more efficient manner. They save you costs. They don't increase, and another key takeaway is they don't, in the intended use here, increase leverage or increase exposures that you otherwise wouldn't have wanted to occur in physical holdings of securities. And the discussion we're going to have today about Portable Alpha is really no different. It has those exact same themes. We're not trying to increase the leverage of your program. We're not trying to increase the risk of your program with the derivatives use in a Portable Alpha strategy. It's trying to allow you to implement a portfolio more efficiently. So that's kind of what we're going to get to next, is explaining Portable Alpha strategies and how they might work. The graphic here apparently did not come off that well, but so I'm going to start by talking about the derivative leg of a Portable Alpha program. So the derivative leg and what we have illustrated up here is a total return swap. And the mechanics of this would be, if the graphic was right, this is you, the University of Missouri. There's an entity out there called a swap dealer. And the arrow that hopefully is in your printed material is you, as the University of Missouri, agreed to pay a financing rate. Say something like T-bills, a short-term interest rate, plus or minus what goes by in the industry as a swap spread. Explain that in a second. And the swap dealer agrees with you is they will pay you the total return of some index, the S&P 500. I wanted to address this point on this diagram here, which is to say the passive versus active question of the beta piece of Portable Alpha. The dealer in these agreements is giving you the passive total return of the S&P 500. There's no active management of the underlying equity positions going on here. But let's take a step back and think about this derivative trade for a second. Sometimes the headline can be confusing, which is, why would a dealer or anybody out there be willing to take in a T-bill rate of return and pay out an equity-like rate of return? We all know equity rates of returns are expected to be higher than T-bills. Wouldn't they be expecting to lose money on a trade like that? They're only going to take in T-bills but pay out equity. At first blush, that might be confusing, but actually what's going on is a very elementary market-making function of the swap dealer. What they will do on the backside of an agreement like this is they will go out and borrow money. Let's say it's $100 million. They will borrow $100 million. Obviously, that's borrowing. They have to pay a rate of interest on that. That rate of interest is the T-bills. T-bills plus or minus the spread. That's what you're agreeing to, if you will, cover for them. You're going to cover their borrowing costs. They'll take that $100 million that they borrow and go buy the S&P 500 or go buy an equity portfolio. And they'll hold that portfolio and earmark all its returns to go to you. That's a very basic market-making function. And so all they're doing is making their spread. They're charging a little bit of a fee to manage that borrowing and funding cost and so on, and passing through the equity total return to you. Those are the very basic mechanics of the derivatives we talk about in a portable alpha context. The total return swap could be written on things like the S&P 500. It could be written on international equity. It could be written on bond indices. It could be written on commodities. There's a lot of flexibility with what you can do with these total return swaps. Now, to answer one of the earlier questions about what derivative instruments might we be using, this is the easiest way to conceptualize the derivative transaction. Well, the primary instruments that's being envisioned to be used at the outset are futures contracts. Now, the futures contract is a little bit different market mechanics behind it, but the economic principles are identical to a total return swap. There's some nuances and differences of futures that aren't worth getting into the details for a high-level understanding here. But this conceptual piece of the derivative leg is an important component of a portable alpha program. And so let's put this together. So this is the bird's eye view illustration of what a portable alpha program is. So the top part of this would be your alpha engine, oftentimes thought of as a hedge fund investment. So hedge funds are typically charged, say with a benchmark or a performance objective of earning T-bills, sometimes that could be LIBOR or what have you, plus some amount, plus a spread, like 150 basis points or 200 basis points. That's the alpha. And that's the magic of portable alpha. If I'd say the whole intent of doing a portable alpha program is the pursuit of that alpha. And also, to be clear, that's not the role NISA plays in this whole equation. Tom, through advice and Barry with SIS, they help identify and ultimately decide on what managers out there can find the alpha opportunities and exploit inefficiencies. That's the hardest challenge of the whole portable alpha program, is that alpha pursuit. The piece below it is the derivative leg. That previous page, which the diagram didn't visually show up as well, is you're paying that T-bills plus the spread, and you're receiving the S&P 500 total return. So in this illustration, you see how the T-bill, or the financing rate portion of the hedge fund, cancels with the amount you're paying out in the total return swap. And so the net that you get after you structure this together is the total rate of return on the S&P 500, plus whatever alpha the hedge funds or your alpha engine delivers to you, plus or minus whatever the spread was on that derivative instrument, the total return swap. So an important takeaway from this is that exposure to the S&P 500 is no different than what you would have had you invested passively. Yes, Rick.
If I'm the beta of the S&P 500, will the university be paying passive type fees, like if it were buying index, or does it pay more? What kind of fees is paid for the beta portion?
Gotcha. So I would say there are two cost considerations to think about at a high level. There's the cost consideration that goes into the derivative instrument itself. And then there's the cost consideration of managing the derivative instrument. Frankly, that's NISA's fee. That's us managing the derivative instrument on your behalf. So there's NISA's fees, and then there is the implicit costs of the financing part of the derivative instrument. In a futures contract, that's the market clearing rate of borrowing. the synthetic, I shouldn't say synthetic financing, the financing rate that the market charges to do that market-making function of borrowing and investing in the S&P 500, that's just a market. And what we'll do as managers is often compare what that rate is to what prevailing very low-risk interest rates like T-bills or LIBOR is. Dodd-Frank regulation, quite frankly, has raised the cost of some of that financing. These numbers, the spreads, swap spreads on S&P 500 would be in the neighborhood of 30 basis points today.
And that compares to what for this bond index? It's 5?
If so, a passive mutual fund or something like that, it's probably in the neighborhood of 5 or so basis points. Interest prior to Dodd-Frank, and I actually have some expectation this would be a different conversation to have, but that we may eventually return to these levels. There's a lot of uncertainty going on in the broker-dealer community about what their capital charges, regulatory charges, other charges that they may face as a function of Dodd-Frank regulation, which is driving some of their risk considerations up. But prior to Dodd-Frank, those numbers were low single-digit basis points. Spreads sometimes, and sometimes they're even negative. That's a different story too. But so on the next page, I think what we have here is wanted to compare a portable alpha program, which is off on the right, to other strategies that you've either contemplated in the past or are currently pursuing. So the left, the far left, I'll start here, is the very simplest, just passive investment in an equity portfolio. So kind of starting at the top here, balance sheet impact, or i.e. what shows up on your portfolio holding statement, is you hold a bunch of stocks, S&P 500. The component return stream, or what do you get for that holding? Well, you get the return of S&P 500. No surprise there. And then ultimately the amount that you earn, which shows up on your income statement, is the total return of the S&P 500. Of course, whatever passive fees or management fees there might be in that pursuit, that's in there too. Now let's compare that to a cash securitization program. This is what we talked about back in 2013. You might have, say, $100 million of cash laying around earning something like T-bills. So you have cash earning a T-bill rate of return. What we can do as a derivative manager is step in and overlay that cash with the total return swap or a futures contract, where we pay T-bills and receive the total return on the S&P 500. The T-bill return cancels, and what you end up with is that same exact exposure to the S&P 500, and again, plus or minus whatever that spread might be on the derivative piece. So same exposure, importantly. And now portable alpha. I think the concept here that's most instructive is really what's going on in this top box. Instead of under the cash securitization example, where we had it all in the lowest risk instrument possibly imagined, T-bills, we've taken some of that and given it to some entity out there, i.e. a hedge fund, to pursue alpha, active management. And the construct that's being contemplated for you is roughly a 2/3, 1/3 weighting. 2/3 of that $100 million would be given to active management or alpha pursuit, and 1/3 would remain in T-bills as liquidity for derivatives management and adjustment purposes. And so you would get the alpha and associated fees to an earlier question with $67 million. You'd have the equivalent of like a cash securitization program of $33 million. Same exact derivative instrument is used, same exact amount, $100 million, as the cash securitization example. And now what we've introduced in this is the alpha concept. Now the net that we get out of all this is that same equity return, same spread on whatever the derivative instrument would be, but we've introduced the alpha coming out of the hedge funds. And this is exactly where this whole structure gets its name, portable alpha. What we've done here is we've taken the alpha that's produced by some entity like a hedge fund and ported it on top of whatever asset class we want. Illustrated here is the S&P 500, but it could be, frankly, any asset class you could think of. And so that's where it gets this name of portable alpha. And importantly, without derivatives, this wouldn't be possible. If not for derivatives, you would be faced with the proposition of, I can either take my 100 million and invest in equity and get equity-like returns, or I could take my 100 million and invest in a hedge fund and get a T-bill plus alpha. Which one do I prefer? That's a harder decision to be had than to say, I like the returns of equity market exposure, but I want that alpha. Derivatives free up that flexibility and allow this to happen. And that's the crux of the structure here.
You have a negative return on the S&P.
Right, so, well,
Let me address that.
oh, sure, go right ahead.
I want to get back up at a little bit higher level. Your question was, what happens if the S&P goes down?
Yes.
So, and again, just at a higher level, without the rocket scientist and more in the layman's terms, what this program in essence allows us to do is to get two different return streams of hopefully income over time off of the same set of capital of cash. It's a more efficient way to invest. And it started, and this gets back to the question about fees, it started with this thinking about how do we want to get our equity market exposure. And it then led to this conclusion that probably within the US equity space that we're better off in some kind of a passive product, because for the most part, active managers in US equities basically can't generate the alpha to pay for their fees. So then we're at the point where we're ready to go in some kind of a passive exposure to US equities. And then we think again, okay, now that we've made that strategic decision, what are the different options that we have to do it? And that's one of the things that we just went through. I mean, we could do it in a passive manner with the BlackRock Index Fund, but in terms of trying to find additional return streams, portable alpha, again, is something that's very common in institutional investing. And once we made the decision to get a passive exposure to equities, then the portable alpha discussion strategically becomes pretty easy because it allows us to increase the returns, dampen the volatility. And really, to get to your question, having set that up, we went back from a risk management perspective and we looked at what a portable alpha program would have done through the financial crisis, because there's nothing better to look at than something we've all just lived through. So we took a look at the S&P 500 from peak to trough, which was roughly in the summer of 2007 was the peak, and the bottom of the market was in March of 2009. So we took the very best point to the very worst point and just looked to see what would have happened. And we actually had the return streams of the hedge fund strategies that would be likely to go into the program. So over that time period, the S&P dropped about 40%. I mean, we know that, right? We lived through that. Again, that's from peak to trough. It did recover after that, but we wanted to look at the worst case scenario. So during that same time period, the portfolio of hedge fund products we had looked at had a return of 6%, which kind of gets back to the point. One of the sort of the return enhancement or volatility dampening aspects of this, whether or not we want to call this alpha, and we can agree or disagree whether alpha exists. The key thing to me in the hedge fund and in the strategies that are selected is that they're non-equity return streams. So we want to put in things that will diversify the equity exposure within this portfolio so that hopefully if equities go one way, the hedge fund strategy doesn't necessarily go along. Now, during the financial crisis, during that time period, did some of the hedge fund strategies incur losses at certain points? Absolutely, everything did. But with the management overall through the cycle, again, the sort of proxy hedge fund portfolio actually returned 6%, while the S&P 500 dropped 40%. And that's pretty indicative and representative of what happened with our hedge fund portfolio generally during the crisis. It was the best performing part of the portfolio. So this accomplishes really several different things, but ultimately it started with the strategic decision on U.S. equities in terms of we want to be in that space, but what makes the most sense? What's the most efficient way to get that market exposure? Once we determine basically that it's probably a passive-like product, then we would begin to evaluate the different options for how we would achieve the passive beta exposure. From a cost perspective, honestly, it would be cheaper from a cost perspective to take it and put it at BlackRock and pay maybe 4 or 5 basis points. But that's ignoring the possibility of the more efficient utilization of our capital with the Portable Alpha program. So that's why, when I think about costs, in my view, cost should not drive strategic decisions. We should make strategic decisions and then figure out the most cost-effective way to implement those decisions. So if I were totally driven by cost with this, the money would go to BlackRock, and I'd give up the opportunity to earn the marginal returns and also the opportunity maybe for the volatility dampening on my equity return stream. Having said all that, again, from actual experience, worst case, what would have been the riskiest part of having this program during the financial crisis? It was the S&P 500. But we owned that already. We already owned the equity exposure. That's another key point with this. This doesn't change the equity exposure that we already have in the portfolio. And that's really where most of the risk is. All it does is it offers us a means to, again, produce two return streams for the same pool of capital using relatively plain vanilla instruments that are commonly used by other peer institutions.
I understand that. My question is, though, if the S&P goes down, then on the alpha portion there, or the portion there, do we just, the contract's canceled and we lost our contract money, or do we have the same risk exposure to the S&P?
So you still have the S&P exposure no matter what, and that's where that mix at the top, in the top right-hand bucket. Our goal in targeting this program is to start out with a cash margin of about 33%. So if this were a $100 million program, we'd have $33 million in cash. That's the initial cushion to cover it should the S&P fall, because each month or whenever the contracts settle, there's a mark to market and you settle up. So if the S&P drops, you have to pay the other party, and that's where the first source of cash is in the margin that we would keep basically sitting idle as a risk management tool. Does that get more to the?
Let me try, maybe a real quick illustration would help with that. Let's say you had $100 million invested in equity. We're in the left bucket. Now the equity market drops 20%. You have $80 million equity portfolio. Period, end of story. Very simple, easy to understand. Over here, we do this structure, and now that exact same market event happens. The equity market drops 100%. So we have a total return swap giving us exposure at the start to 100 million of equity. It drops 20%. We owe $20 million on that derivative instrument. And if we settle up on that tomorrow, what we do is we take 20 million out of our $33 million of T-bills and send it over to our derivatives counterparty. Now we have a portfolio that's 13 million of T-bills, 67 million of hedge funds. That's worth $80 million. And we have a derivative instrument that's getting us exposure to $80 million of equity. Same equity exposures we had with our passive investment. And at that point, one would want to think about replenishing the T-bill balance to increase it, and that's part of these programs.
This is a more generic question just on derivatives, but some financial writers refer to derivatives as being risky. But didn't Dodd-Frank affect the ability of banks to invest in derivatives? And don't they have to do it through subsidiaries? Now, if they're an FDIC bank, didn't they limit the ability of banks to invest in derivatives?
So Dodd-Frank and its implication is incredibly widespread and incredibly complex. But really what the Dodd-Frank legislation was intended to do was address the systemic risk that exists on the counterparty to your trade, from your perspective, side of the equation here. What happens if the equity market goes up 20%, they owe you $20 million, and they're not good for it. Dodd-Frank was in very crass terms here, to put belts and suspenders in place that would assure that those broker-dealers, the banking community out there, would be good for those derivative contracts that they commit to. And that functionally, one of the ways they do that is to disincentivize them from putting derivatives in place. That's some of the reason that derivative contracts have a little more regulatory overhead to them these days.
I'm kind of naive about all of these sophisticated financial instruments. Most of us don't invest that way ourselves. So the synthetic investments or the derivatives and the hedge funds are, sort of beyond our everyday investments. But it does seem like this portable alpha is a little bit, and I'm not very good at poker either, but buying insurance if you're playing blackjack to cover your downside. And you can take any period of time. You've demonstrated in the recent down market that hedge funds actually did better than the market, of course, or at least many of them did. But if you take a different period of time, and I would move it forward, hedge funds have become, again, risky in an up market. When you said, when you introduced that topic, you said, i.e. hedge funds. Are we talking about just hedge funds in that portable alpha, or is that an example of what you would be using in your portable alpha? That's question number one. So it's an IE or EG. And then secondly, what about all these other well-known endowments and universities that are pulling out of hedge funds because of the current riskiness and the bad results that several are getting? Some of the smart hedge fund leaders back in 2008 through 2011 are saying, you know, that they're now not doing well. So, you know, I wonder why some of the really good, large universities and endowments have pulled back from that. And
Well, let me address that, and I might ask Barry to join in too. That's really not the case. There's a lot of misconception out in the press, and there's a lot of misunderstanding even in the media in terms of what a hedge fund is. The biggest thing that started off this discussion was a decision at CalPERS to pull out of their hedge fund allocation. And Barry is more familiar with the details of that than I am. If you really look at what they did, despite what they said, one of the main reasons they pulled out of hedge funds is that they realized that hedge funds would never make an impact on their portfolio because they had a $6 billion hedge fund portfolio, Barry, does that sound about right, on maybe a $300 billion portfolio overall. And I think what they decided is that based on their size, in order to get the critical mass needed in a hedge fund portfolio to make a difference overall, they couldn't do it. They were too big. So that was as much the reason that they got out of hedge funds as anything else. The other, common misconception that you see, again in the press, are these comparisons of like hedge fund returns to the S&P 500. Well, hedge funds were never meant to be equity substitutes. So writing an article or reading an article about how hedge funds as a group are underperforming the S&P 500 is kind of irrelevant because they're really designed for two completely different purposes. And the best illustration of that would be looking back into the financial crisis. When equities lost 40%, the hedge fund proxy portfolio was up 6%. That's why things like hedge funds are in the portfolio, because they're diversifiers. But to compare in sort of these common media terms, this hedge fund proxy against the S&P 500 is really a false discussion from the start. But it gets fed into the media and the stories, and then the CalPERS decision gets fed in. But again, if you look at what they've really done, they had other reasons for doing it.
I did read the analysis of CalPERS reasons, and I do appreciate that. But others have withdrawn from the hedge fund arena as well. And I don't think you can use the argument about how well they did in the downside, because that's part of what they help do, is cover the downside, and then say, well, when it's an average or an up market, you can't really compare it because you just did compare it. So, you can't pick your time period and say this is good for the down market, and then.
But I'm really not, though. I mean, if we go back into Barry's presentation where he talked about the expected returns of the various asset classes, the hedge fund line item is clearly lower than the equity line item. But the volatility assumption is lower as well, which is an important part of the diversification of the overall portfolio. So it's our, I guess, recommendation and feeling that the hedge fund products, in terms of the ones that we would use, add value to the portfolio. If we didn't feel that, if we didn't have that conviction, we wouldn't bring the recommendation to the board. In terms of fees, yes, we like to get the fees as low as we possibly can. We actually have some firms that believe in low fees as well, and those would be some of the products that we'd like to put in. But every one of the asset classes that we talk about has a purpose for the portfolio and serves a purpose. And to compare everything back to the S&P 500 and what's going on into equities, I'm just suggesting is certainly a way to look at it, but from the portfolio management perspective is maybe not the best way.
SIS brought the concept and recommends it, and so does the university. I'm supportive of it. I'm just playing the devil's advocate to try to understand it a little bit.
Is it possible if you redefine what you are talking about as hedge funds in another way and don't call it that maybe John would be more accepting of it?
Yes, let me try to explain. In our book, we had a hedge fund asset category, and it had an expected return of 6.5% and a risk of 10%. We also had a portable alpha category. It had an expected return of 1.5%, a lot less than 6.5%, and an expected risk of 2.5%, a lot less than 10.5%. What we're proposing to port over the beta stream is a set of very low-risk hedge funds. 1/4 of the risk of what you get in a typical hedge fund. Does that answer your question, sir?
Makes me more comfortable.
Good, thank you.
Anything further for any of the presenters on this subject? Tom, do you have any closing?
We've got some, well, I cut off.
Yeah, let's.
Maybe just risk management, the key, you kind of touched on that at the very beginning. But one of the reasons that we feel very comfortable partnering with NISA is because of the robustness of their operations and the infrastructure that they have in place, the position they have within the markets. They're well equipped. They're as equipped as any firm in the country to deal with it. It happens to be a bonus for us that we're an hour and a half apart down the road, which makes it very easy to build a very strong partnership. And I think I'll end on that and thank you guys for coming up. And I'm just going to wrap up a summary of the recommended changes to the collected rules. So part of it, just to follow right on, would be with the Global Equity Portable Alpha Program. So this is speaking to changes that are actually in the collected rule recommended changes that we would ask that you vote on at a subsequent meeting. So there's a discussion in the collected rules that would clarify again the derivative instruments used for synthetic market exposure. And again, the board had previously approved that usage in October of 2013. We would limit the synthetic equity exposure to 50% of total equities overall. And that's just sort of a larger risk limit to say that if we were going to have overall $1 billion in equities, it's just saying that no more than 50% of that equity exposure would be derived from synthetic instruments. It's actually going to be less than that. The Portable Alpha Manager Program, the target for that would be a maximum of 10%, both the retirement and the endowment portfolio with an allowable range from 0 to 15. And the only reason that the range would go above the 10 is that you could have periods in the market where just quick equity moves could alter the percentage of those hedge fund holdings as a percentage of the total portfolio. So that having that range a little bit wider would give us some leeway to act and react to what might go on in the market. Would require, beyond what's in the collected rules, it would require the implementation of a formal risk management policy.
Before you go on,
Yeah.
the second bullet point, what is our current synthetic equity exposure?
Currently, it's 0.
So we're authorizing a shift from our current equities, which are going passive, to up to 50% into synthetic?
That would be an upper limit. Again, it's a broad limit. The portfolio itself would be less than that. One of the things I wanted to mention is back to the presentation in October of 2013 when the board policy was changed. That was just just as an aside, that was during a period of time when I was serving as both the treasurer, CIO, and interim CFO. And I had made a decision, even though we had board approval to move forward with the cash rebalancing and the overlays that we talked about earlier, I had made the decision not to do it at the time when I was doing two roles at once because I couldn't give it the attention that it deserved in terms of implementing the program. So where it's been approved, we haven't implemented that previous part that was approved by the board yet, but we're working on that now.
Tom, can you clarify, please, with respect to the synthetic equity exposure percentage, whether you mean that as to the entire portfolio or simply to this segment?
That would be, the language is specific to whatever is allocated to equities. So if 20% of the portfolio were in equities, I'm just pulling that number out, then 10% of the 20 could be derived through synthetic exposures.
The entire portfolio?
Of just the equity piece.
Right. But
Yeah.
the entire equity piece?
Yeah.
What is the current equity piece?
Our recommended target is in the 40s. Yeah.
All right, so we're talking about moving half of 40% of our entire portfolio up to 50%. So it'd be 20% of our entire investment going from 0 to 20%, potentially. How'd you pick 50%? Because that seems like we're just shifting from what has been a largely actively managed equity base to a different way to actively manage it and decreasing the passive investments.
Okay, so a couple different angles on that. One is we look at the equity strategy overall.
Well, how'd you get the 50%?
Well, I'm getting to that as from two different angles. So
Okay.
one, U.S. equities are about 50% of the global equity market. So we're running a global equity program right now, have been for more than 5 years in the portfolios. And part of that strategic thinking was, again, thinking about what's the best way to get the exposure. And I think we've reached the conclusion, again, in the U.S. equity space, particularly in large cap, that active management is probably a losing proposition. And so if we're not going to actively manage the U.S. equities, which are roughly 50% of the portfolio, then it's kind of back to, so how do we want to gain that exposure in the most efficient, effective way possible? So that's one angle. I think another angle is just more from a risk management perspective. You could certainly implement your entire equity program with synthetic instruments and derivatives. But I think you would want to think about risk perspectives on that, counterparty risk, things like that. So that's another reason that we didn't want to go beyond that. We want to have physical securities for the other 50%, whether they're in passive products or active products.
That still doesn't get, the first point you make of the 40% that's currently in equities, you could simply switch them to passive and you wouldn't have the active management fees. So that doesn't help. And it doesn't really get to why would you go to 50% synthetic? Why don't you stay more in, 30% in equities that are passive? I still don't understand how you go from 0 to 50%.
I think I'm missing, I'm not.
Well, it says it limits the exposure, 50% of the total equity allocation.
Right.
That's 40%.
Right.
So if we give you that authority, next year we come back and you will have moved a fair, almost half of the investments into a different way of actively managing the equities.
Tom, could I just-
Yeah.
This question.
Yeah.
Portable Alpha is targeted at 10% of the portfolio. Remember Dan's slide where it was 67 million and 33 million. So if we have 10% in Portable Alpha, we're going to have 15% of the total in derivative exposure. So if our target is 40% and half of that is 20%, we're targeting 15%. That 50% limit gives us 5% of cushion. Okay?
maybe, I'm not entirely clear about that.
Just to be clear, though, just to make sure we're on the same page, what we're saying is that if 40% of the portfolio is in equities,
Yep.
that half of that 40% could be implemented synthetically.
Yes,
Okay.
right.
And remember the question I asked in your office, and your answer was so easy for me, third grader, but I say, what's the downside on this? What do we have to lose? And your answer was?
Okay, there's again, there's really two different issues that come together. One is the synthetic implementation of market exposures. From that respect, this is just another way to gain market exposure. So your actual risk of having synthetic exposure to the S&P 500, your real risk is in the equity exposure, and it's no different whether it's with an active manager, a passive product, or a synthetic implementation. You could have portfolios that are entirely implemented synthetically, and it could be argued they'd be very efficient portfolios. The separate question is when you start to combine that synthetic exposure with the Portable Alpha program, which would be these hedge fund strategies uncorrelated to equities. When we, again, looked at what's the worst thing that could happen and looking through the financial crisis, it really has to do with that cash margin. I'm going to go back and borrow Nissa's slide again. In terms of a risk management perspective, that cash margin starting out, the $33 million, again, if there's a drop in the equity market, which has nothing to do with the hedge fund strategies, but if the equity market drops, with that total return swap, you have to settle up every month. So if the equity market drops 40% and you start out with $100 million, you got to come up with $40 million in cash. So the biggest risk from our perspective and from the board's perspective in running this program safely and soundly is the careful management of that cash margin. And I think that's where, we probably anecdotally can talk about programs that were put together before the financial crisis that had issues. The issues were largely caused by not starting out with enough cash margin, and on top of that, investing in hedge fund strategies that turned out to be pretty illiquid during the financial crisis. And so it caused a big liquidity squeeze. They couldn't liquidate their holdings in the hedge funds. The S&P dropped again over that period, peak to trough 40%, and they had issues with the cash. So in terms of how we would be addressing that from a risk management standpoint, one is we're starting out with a very conservative cash margin of 33%. And Barry or Nissa can speak to what they see across the board with other institutional investors. The other thing would be is that most all of the hedge fund strategies that we're looking at are liquid strategies that offer liquidity at least once a month. So it's kind of, in terms of what do we have to manage, what do I have to worry about at night, it's the careful management of that cash margin.
Because we're still going to lose 40% no matter what on your
Right.
hypothetical. The question is, do we have enough cash to, I don't like the word cover that in the interim?
Right.
If I could just follow up, just because it's important to my understanding, and this is what I was confused at, because I'm actually supportive. I asked some questions and I have some concerns, but I'm supportive of the Portable Alpha, and mainly because in my mind I think of the alpha more as a non-correlated. But to use round numbers, the proposal is about 40%, I think it's 37, but 40% global equities and 10% Portable Alpha. So I interpreted that to meaning 10% of the 40% of our global equity, which is a fourth rather than a 50% being in synthetics. What am I missing? If 10% is the global alpha and 40% is the global equity, then it's only 1/4 basically that we're talking about synthetics, isn't it?
So again, if we could separate two different things.
Yeah.
So one, let's talk about synthetic exposure to equities. So the policy would suggest or recommend that we would be allowed to get up to half of our equity exposure through the use of synthetic instruments. That could be completely irrespective of a Portable Alpha program.
And that's what in yesterday's meeting I didn't understand. Why would we want to go outside of the portable alpha, why would we want to increase our synthetic exposure, basically get the same rate of return and pay approximately 6.5% times in the basis points in fees?
That is the cost of being conservative with your margin. So to get 10% in portable alpha, you need to put 15% in synthetics, 2/3 of the
But,
total.
and I'm not gonna belabor it, I understand portable alpha, I understand going synthetics for portable alpha, I understand why that works, I understand the non-correlated portion. I'm really not sure that I'm comfortable with that large a move towards synthetics outside of the portable alpha program, but you can explain it to
We
them.
can take another look at that. Again, that was meant more to bring a risk control in, to say that we couldn't implement the entire portfolio synthetically. Maybe another way to answer your question, again, take the hedge funds off the table and just talk about synthetic implementation. You raise the question, would you want to have your entire equity portfolio, absent portable alpha, synthetically implemented? Well, probably, again, given the Dodd-Frank regulatory requirements that have driven the cost up, you probably wouldn't want to do it. It wouldn't be the most cost-effective way. But you might want to do it tactically at the margins, because the synthetic exposure allows you to move quickly in and out of markets if you wanted to. Or you might have a large premium for liquidity, where you want ready access to assets that you can liquidate pretty quickly. Because surprisingly, even having money, we have over $500 million at BlackRock in passive index funds, and it still can take 2 to 3 weeks to get money out. So you might want to have some additional synthetic exposure just in terms of a ready access liquidity, because even in a passive vehicle and an institutional product, you can't call them up and say, I want my money tomorrow. So you would use it more from a tactical standpoint. I would agree that absent other objectives, you probably wouldn't implement synthetically. Although I will say, to use an example from a peer pension plan that we're familiar with in Jeff City, the teachers plan, they started to look at, and they implemented the portable alpha program after the financial crisis. One of their objectives actually was to have a ready source of liquidity, because they had some issues with some partners during the financial crisis that caused liquidity issues for them. And this was a way to build extra liquidity, cash, into their portfolio from a risk management standpoint. So there are lots of different objectives. But if there's discomfort with that 50%, I mean, we can go back and look at it. It really wasn't designed to say we're going to put 50% in. It was really more designed to put a risk measure in to say that we couldn't do it all. And we really would have no reason to do all of it anyway. The hedge fund exposure underneath, the separate issue, the portable alpha, that would be limited to 10% of the portfolio. So it couldn't exceed that. And then that had that range of 0 to 15%.
Tom, did you start by saying in that second thing that really this is a brand new category, up to 50%? So what is it right now? What is it before we change the rules?
So it was the synthetic implementation. So again, we got board approval to start to use that in October 2013. We didn't move forward with that program at the time because I was doing 2 roles concurrently. So currently we're not.
Was the number 50%?
Well, there wasn't any limit on it actually in the policy. Yeah.
So it could have been 100%.
The way it was written. So this again was more of an attempt to bring in restrictions.
So actually what we're doing is really limiting what they approved in 2013, is that right?
Yeah, and again, we can take a look at it, because if we don't need close to this, and again, Barry had mentioned there are times when you do need some cushion depending on what's going on in the market, but if we can bring that limit any further and still run the program effectively, I'm not really opposed to that at all.
Well, the discussion in 2013 focused around passive investments. It wasn't how much you were going to put into synthetic
Well, it was rebalancing the portfolio and investing the cash.
Right, but I don't think anybody dreamed that you would take half of our equities
No,
and move them into synthetic.
but it was using
reinsurance.
synthetic instruments to get the market exposure.
And I don't know that we dream of it right now.
What are some of the other examples of synthetics that might qualify for investment?
You mean other asset classes?
Yeah.
So a good example would be with the commodities portfolio. So we're asking to add that. It's very likely that we would do that. We would ask NISTA to do that and use it with synthetic instruments.
Would you match puts and calls?
Now, that's a question I'd have to have them answer. In terms of how we would implement the commodity exposure synthetically.
That is also done with something like a total return swap. Fundamentally, it's really a futures-based market. 20-odd commodity futures trade very liquidly. You could either put a basket of futures contracts in place or a total return swap that has that exact same economic schematic that the equity example I gave earlier was.
It's just a very efficient way to implement the asset class at really the lowest cost possible. Any other questions?
If not, let me assure the board that this is an action item in June, but if there is a consensus that another hour's meeting or so is helpful for question answering at some point, we can discuss this later. Anyone, of course, can direct questions directly to Tom, Brian Burnett, and anyone else. So it's not to say that there will be no further discussion on this issue when Tom sits down. It's simply that because of the schedule, and particularly because we have visitors, that we wanted to allow plenty of time for them to present. But again, not to cut off any conversation that we may want to have after this meeting, and I repeat that.
I'm comfortable with the discussion we've had. My only concern is about having that 50%, and you're sensitive to it, so.
Yeah, and in fact, I'd be happy to follow up. Let me look at that tomorrow back in the office, and if we can bring that in again and still reasonably run the program, we would be indifferent. It was just more intended to put a risk control in place that wasn't already in place.
Thank you very much.
Thank you.
And thank you to everyone who participated this morning. And at this point, any further business, Mr. Chairman, at the Finance Committee?
I guess
Dan?
the Finance Committee will meet again this afternoon.
Oh, in public session?
Yes.
I apologize for that. Correct.
One item I neglected to mention, we're withdrawing item 10 from the consent agenda. That will be talked about this afternoon. At this time, the board will go into closed session, and we will reconvene in public session approximately 12:45.